So as a result of recent market developments, not-for-profits are encountering a pretty unique situation. And what I mean by that is at the same time as they're experiencing a reduction in the level of income that they're receiving off their portfolios, and indeed a more restrictive environment on donations, they're also seeing a dramatic increase in the demand for their services. And so that puts them in quite a tricky situation. And so, really to try and come through this in the strongest possible way, it's important for not-for-profits to consider the sources of their income and how they're likely to change under the current environment. Over the past quarter, markets have behaved in a relatively calm way, particularly when we consider how 2020 has played out. When we look across markets, Australian equities, really didn't do much. They sort of treaded water for the quarter. By the end of the 3 months, we actually saw them draw down by 0.1%. So practically a flat quarter. When we look at globally, we're actually seeing a little bit more differentiation. And certainly, when we consider international markets as a whole, we're seeing returns of closer to 4% for the period. And here, this is largely driven, unsurprisingly, by those US tech stocks. So your Facebooks, your Amazons, your Google, your Netflix, all those kind of beneficiaries that we're all very aware of have enjoyed the stay-at-home lifestyle that's been imposed on us. So dividends form quite an important role in terms of income for not-for-profits. And of course, a large part of that is driven by the benefit of franking credits. The current environment has put quite a strain on dividends as companies have felt the need to strengthen their balance sheets and protect themselves against the uncertainty of the environment we're in. Ultimately, what we're expecting in the current environment is a reduction of just over 30% from dividend income from Australian equities. Moving into 2021, we are expecting a small uplift, but I think we should temper our expectations. We don't think we'll be returning to 2019 levels immediately. So with the current environment impacting dividends, different types of trusts are going to have slightly different experiences, and that's going to have knock-on effects. So for private ancillary funds and public ancillary funds in particular, both have to distribute a minimum amount every year. And for privates, it's 5%, and for publics, it's 4%. So with reduced income returns being produced, there's a good likelihood that these funds are going to have to draw down on capital to meet their distribution requirements. And of course, that drawdown on capital reduces the capital base, which will lead to lower amounts of income in the future. So there's a real risk of a compounding effect of this issue. In the coming months and years, a crucial question for not-for-profits will be related to their funding. And so understanding their sources of income and the types of trusts that provide that funding will be a crucial point to understand future trends. In aid of assisting with this, we've developed a paper which deep dives into the impacts of COVID-19 on philanthropists and not-for-profits and provides practical steps they can take to manage them. You can download it on our website, or feel free to reach out to your financial advisor.